Hello and welcome to our latest strategy outlook. Looking ahead, an already strong recovery should be even more robust thanks to vaccines and continued spending. New US fiscal stimulus and accommodative monetary policies are indeed key. The American Rescue Plan will both lift US growth through income support measures and give global demand a boost. As US growth accelerates, the Federal Reserve will keep financial conditions accommodative. We don't expect the Fed to raise rates before 2023, and that's because its new framework lets it watch the economy overheat until there is full employment and inflation averages 2% over time. That gives us a clear 2-year window for US economic activity. Things look slightly different in other parts of the world. Europe's third wave puts it on a slower growth path so that the recovery will take more time. That demands a more robust response from both the European Central Bank and governments in Europe. In China, the focus is already shifting. As the first economy to recover from COVID, China is also the first to signal tightening of its monetary and fiscal policies. Of course, there are still risks, including the evolution of the virus, the vaccine's effectiveness, and premature end to government spending and ongoing geopolitical threats. But as we said, the recovery looks solid for now. Growth is strengthening, inflation is showing signs of normalizing, and so markets have started pricing in post-pandemic economy. What impact does this all have on our portfolios? Well, let's find out from Stéphane.
As Samy said, markets have reacted to the focus on inflation and higher interest rate with rising yields. The move has been rapid and large. The US 10-year yield nearly doubled to 1.65% in 3 months. The Fed's average inflation targeting approach makes us think that the markets may have gotten ahead of themselves. We see 10-year US Treasuries capped at 2% this year and probably at 2.5% at the end of the current recovery. We have been positioning portfolios with this in mind since September 2020. For instance, we increased our exposure to European, UK, and emerging equities. These tend to benefit from the rotation from growth into cyclical stocks. Also, we reduced position in high-quality bonds and gold, which don't perform that well as yields rise. The question now is, do rising long-term yields threaten equities? We don't think so, but we believe that we need to be more selective in terms of region, sectors, and styles. Small capitalization, which suffered during the pandemic, can offer opportunities as they catch up with reopening economies. Besides, their valuations look attractive. Furthermore, we have reduced position in Chinese equities. As Samy mentioned, we expect China's monetary and fiscal policy to normalize, making it less attractive to hold Chinese equities in the short term. However, longer term, our strategic case for owning Chinese assets remains unchanged. Globally, the recovery supports equity markets, which still offer some hedge against inflation as long as price rises do not threaten company margins. In currencies, better growth and improving trade means we still think the dollar has room to weaken further. And so we are keeping our overweight position in the renminbi and the Japanese yen. The pandemic has started a new path for financial markets, with new opportunities and risks. Rising yields are a normal part of the recovery as long as there is no unexpected tightening of financial conditions that could damage the economic healing. And we see no sign of this at the moment. As confidence in the recovery grows, we will continue to adjust our exposure while keeping an eye on structural transition in sustainability, digitalization, and geopolitics, which are all already shaping our new daily reality. Thank you very much for watching.